Well, as we look across markets, we ask ourselves, is the bull run that we've been seeing, the juggernaut of a thing that is gold, is that run over now? Are we likely to see a bit of a downturn? Blake looks at some charts around that. We look at the US dollar and ask ourselves, are we about to see a bit of an upturn? Are we going to see a bit of a renaissance coming through in the US dollar as well? Has this so-called buy everything rally still got legs, or is it time to sell everything in that situation? And we ask ourselves, where is the vol? There is just none across asset classes at the moment. We ask ourselves, is it time to buy volatility in this market? So many questions, and we hopefully have some of the answers. It's Blake and I in the trade-off today. Hello, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we'll be discussing all the charts that matter, the movers and shakers, the news that's on front of mind at the moment, and where the risk is in these here markets as well. Mr. Blake Morrow, please come into the programme, my good sir. 3 months till Christmas. Happy days. We're on form now, but look, a few things going on, very low volatility. How are you seeing things at the moment? Are you actively trading at the moment? Are you seeing how are you reading the markets?
I'm very actively trading right now, Chris, and I have so much to talk about. And I'm so excited to troll you with the Santa Claus rally, a mumbo jumbo that we do every season. I think
you're going to be the first person in the financial markets to bring out the Santa for this calendar year. I think you probably must be the first person to do so, and maybe you're going to start a trend.
I might. I'm a big Christmas celebrator. I love it. And I'm just, I think I'll just be covering my shorts right around then.
Beautiful, mate. Well, look, let's go into the markets and let's go into topics and see what's going on in the markets and go for a bit of a deep dive. Well, I want to touch on volatility because I think realised volatility is the most important factor in financial markets. It's what the options market trades on. It's what the volatility dynamic funds move on. It's what the whole option space is really predicated on. And, really it dictates position sizing, our time in the market and all these factors playing through. So for me, volatility is really key and getting a harness on whether there's likely to increase and what that means for our position sizing, how we react. But right now, it is absolutely shot to pieces. I know we've got the VIX at 16%, but if you have a look at 20-day realised volatility, what actually the close-to-close realised standard deviation is, it's around 7. I mean, it's just rock bottom levels at the moment. And there is a bit of a risk premium between the VIX and where realised volatility is. And that's keeping a handbrake, keeping a lid on where the VIX is going and implied volatility is going. FX vol is, you can go to G10FX and look at 1 month or 1 week implied volatility and see it's all below the 10th percentile of the 12-month range. The move index in treasuries is 75, multi-year lows. Rates volatility through swaptions is just collapsed recently. And everyone says that, buying volatility, buying that portfolio insurance is dirt cheap now, but no one's really doing it. Everyone's selling volatility on any kind of spikes. You can see that in the ETP complex. Hedge funds are just trying to get any kind of yield that they can. Buying volatility does come with a pretty lofty carry component to it. So they are something that people only want to buy volatility when they really need to and when they get high conviction. But everyone's short volatility across all asset classes at the moment. And, do we get a situation now that it's cheap? Do you want to be buying some volatility for options, buying some puts, or, how do you see this evolving? Is it still stay short volatility?
No, I don't believe it is, Chris. And I think this segment couldn't be timed any better. I know we're going to talk about all different types of markets and where we think markets are going, but I think volatility is dirt cheap. And I think it is something that even if you're playing some of the ETFs that might have, a little bit higher leverage, that might even be a good way to do it for some of you day traders. But I think, or maybe even swing traders, I think this is the time that you want to be protecting yourself. We're seeing a lot of chinks in the armor right now, Chris, in the markets as a whole. And I think this whole episode is going to be really, really designed around that particular topic. And I couldn't agree with you pointing it out that this is the time that you need to have an eye on volatility.
The problem with buying volatility as I say, even if premium is crazy cheap, there's an opportunity cost. You go and buy the premium, you've still got to pay the premium even if it's low, and that takes away from the alpha for people who need to benchmark and be active in the market. So, and it does come with a carry if you're holding that through. If you look at the VIX curve, for example, it's heavily sloping forward, and that comes with a carry component on it as well. So that's why people only really want to go long volatility when they really need to. Maybe some gold in the portfolio has been working quite well as a sort of an uncorrelated asset. But yeah, I think you're going to start seeing people looking to buy it a little bit more, but everyone's just selling volatility, short dated, not go anything above 3 month volatility. It's all 1 month, anything less, bang, just sell it every time. And that's causing, correlations in markets to really come under pressure. Buybacks are also helping the volatility or lower the volatility. And obviously you've got the big Fed put in the market as well. So, I don't know if you're going to get huge upside in volatility here, but I'd like some.
Yeah, and I think we'd all like some as traders for sure. But let's change the topic over to the markets, and I want to talk about something that's been unfortunately we weren't able to film the trade off last week, but I think I said at the very end of the show, look, I'm going to get short at the FOMC as soon as FOMC is out. I'm looking to sell that rally. And actually, I think what the signs that we're seeing even as of today that really the buy everything market is coming to a close, and that's the way I'm seeing it. I'm seeing that the dollar is trying to forge a pretty significant low. I think that you see some of these stocks. You had the Nvidia last gasp maybe a couple of days ago, and I know you're gonna bring up the Nvidia chart, so make sure you all stick around for that. When they did that investment into OpenAI, and really interesting news surrounding Nvidia, which I'm sure you're going to be mentioning. But also, if you see gold today had a what we call a end of the day for me, guys. The candlestick pattern is dark cloud cover, and that's usually at the very tail end of an explosive move, and that is where the CME closed. Gave us dark cloud cover, which does suggest that there might be a high they're forging. Now, I know there are other markets out there. I mean, you look at Bitcoin still kind of ranging in this very, very tight range. Hasn't gone up, but it also hasn't sold off. You look at silver, and silver actually still looks pretty strong as well. But I'm getting the feeling at this point that the buy everything market is coming to a close. How are you seeing the markets right now, and based on your viewpoint, Chris?
Yeah, I mean, it's tough to bet against the buy everything market. I still think there's probably some juice in there. But let's talk about what you mean by the buy everything market. Are we talking buy Nasdaq, buy S&P, buy tech, buy gold, and buy treasuries as well? Or are you looking at the correlation between treasuries and stocks and seeing it break down? Do you think it's going to pick up a bit now?
I'm not, and I think so. The treasuries, as far as the real risk off, I think if we saw some real risk off, I think that might juice or goose the treasury market a little bit. But we're also dealing with in the U.S. treasuries. We had a 5-year auction today; it didn't go really great, and we have a 7-year auction tomorrow. So I think we got to get past those. But yeah, I mean, precious metals, indexes. I mean, you see the German markets kind of slowed down a little bit here. It's not making gains like the rest of the U.S. equity markets have been. But I think that the buy gold, buy silver, sell dollars, buy Nasdaq, buy the Dow, buy even the Russell. I think that market's coming to a close right now, and I think that this is a big turning point. Seasonality is going to have a little bit to play.
Well, we're in that period now, but I would also say, I mean, I don't think anything's changed. I mean, I would say if we're going to see it roll over, it's just a market that's got way too long, taken a bit off the top, and I think that gives you a better entry point. When you look at gold, I think one of the most important reasons, obviously everyone owns a piece of gold at the moment, but I think the problem with me for gold is you've got to look at the correlations between gold and other asset classes, and it's very, very low statistical correlation with equities, the S&P, treasuries, and also Bitcoin, to be honest. The diversifiers are undiversified. But, so for me, I think if you're an investment manager, you're loving gold because it's been a hedge that works well. It's a diversifier that works well, and it's got no statistical correlation with, these major asset classes. So, you want to put that in the portfolio. Traditionally, people have said get 5% of your portfolio in gold. I reckon it's been pushed up to about 10%. And there's just a million reasons why gold's doing its thing. But the correlation is the most important, or the lack of correlation is the most important thing as a diversifier. So I think really what you're seeing now is you're at risk of a bit of a position adjustment, some of the extensive longs coming off the top. And I think there's going to be a lot of people looking to get back in very, very quickly. So I don't think the investment case has changed. I think all of this just comes down to positioning. And we just need that sort of trigger because the elastic band is a bit primed, and that probably gives you an entry point.
And we may have a couple of those triggers. And one of the other things, I know we need to move along, Chris. One of the reasons why I wanted to be short equities following the FOMC, which, by the way, I am. I'm talking my book right now, but I'm basically break even in my position. Actually, just slightly underwater, a few handles, but it doesn't really matter. When the Fed starts cutting rates, typically they're cutting rates because they are trying to curb slowing growth. And in this case, the labor market is starting to show some signs of weakness, and the Fed cutting rates is usually on the cusp of a recession. And actually, if you look back when the Fed cuts rates,
don't go there.
Hey, I'm gonna go there. But if you look at when the Fed actually cuts rates, the last time they've cut rates back in 2019, prior to post-COVID, I'm talking pre-COVID. We are on the cusp of a recession at that point in time. Then COVID hit. So I'm in that camp that I think that the Fed is actually cutting rates to curb slower growth, and that is going to weigh on equity markets.
Well, I take a slightly different approach to that. I mean, I think if you look at the rates markets, the US swaps markets at the moment, they're saying the Fed are cutting rates into a soft landing. The fact that the terminal price, or the low point in the market's pricing, is 3%, pretty much in line with the Fed. That tells me that they see a soft landing. They don't need to stimulate, go into an accommodative setting. So the equity market and risk markets love this idea that they're cutting rates into a soft landing. If they're cutting rates into a recessionary type anticipation, so we saw in the terminal pricing at, say, 250, I think that would be a big equity negative. But I think the market's saying that we've got the business sector is strong in the US. I mean, obviously most of the capex is in the AI space, but you've probably got the economy growing about 2.5%. The business sector is fine. You've seen that in the ISM and the PMI surveys, but it's where the weakness is in the consumer, and you're seeing households saying that we've got real purchasing powers falling. We're finding jobs ever harder to get. We're worried about inflation in the future. And that's where I think the fragility is. I think the business sector is looking pretty good at the moment. But yeah, so I think if there is going to be a recession, I think it's going to be a consumer behaviour one, not anything to do with businesses. And obviously that's why we look at the layoff rates, because businesses at the moment are not hiring, but they're not laying people off either. So that's when we look at the JOLTS report coming out and we look at the layoff rate of 1%. If that was to start ticking up with continued claims, then I would start going, you know what, Blake, let's talk about a recession being 45, 50%. But at the moment, we're seeing some fragility, which the Fed are trying to ring fence, but the business sector is still pretty strong. And I think that would need to change to call that recession probability higher. That's the way I see things.
Sounds good. And you know what? We're going to be having this conversation a lot over the next couple of months, I believe.
Exactly. Anyway, it's a good topic then to bring in the dollar because, what did we get? I think the dollar index got down to 96.21. And it's had a rebound now, just shy of 98. So it has had a little bit of push. We were sort of just testing the August downtrend at the moment in the Dixie. Dolly yen's broken out. It does seem like it's had a bit of a move. And I think I put that down largely to positioning. Everyone was short the US dollar, but also, people have looked at the rates pricing. And I think we had a very rich and full pricing, and people said, well, we're not going to get any much more. So, if you look at one year forward rates in swaps, they've gone from pricing a terminal price and Fed funds of 2.81%, and that's now 3.05. So, you've seen the expected low point in the Fed cycle, moving up 24 basis points, if my math's correct on that. So, and 2-year treasuries have gone from 3.46 on front end to 360. I think they could probably push up to about 370. And I think that front end move and the rate story, rate cuts being priced out, is probably the main reason why the dollar's rallied. Although I don't think anyone actually really fully knows. I think, we did see a massive corporate issuance last night from, was it Oracle? I think at $15 or $18 billion, second biggest of the year. I think that sucked some liquidity out the fixed income market and pushed up yields. That maybe helped the dollar go up. I think that was probably one of the big factors there. But, the question I'm going to ask for you now, Blake, is given that everyone has been so bearish on the US dollar, expecting a leg lower, including myself, is this rally we've got sustainable? Do we think it's got legs, or do we think we're just going to see some chop for the short term?
Well, I think it does, and I think it does probably for a lot of reasons that you typically wouldn't want to hear. But from a tactical point of view, I believe that this is the level that if you're going to make a stand as a trader to be long dollars, this is it. This is the best risk reward you're going to get. And if the euro takes out 119.50, then we got a different story. But at this point in time, and I think it goes back to the conversation that we had two weeks ago. I think what really puts the dollar on its knees is a disruption at the Fed and a loss of confidence in the Fed. Lisa Cook is still a big name that should be talked about. But with that being said, I think the dollar, when you're looking at, from a macro point of view, as you point out, the U.S. economy is still quite strong, and relative to other economies, it is as well. And a lot of analysts and a lot of bank research that I've been reading, they're just looking past everything that has been priced in thus far. So I do think that the dollar has the ability to at least bounce near term from here. Do I think that the euro is going eventually above 120? I do. Is that a 2025 story? I don't think so. I think it's a 2026 story if we're going to see it. So for right now, near term, I am more of a dollar bull, and I am looking for dollar just from a positioning standpoint, Chris. And that I'm looking for a dollar to rally from this stage.
I want to just put you talked about this Fed independence, and which increases the sort of risk premium in the US dollar. But I think the Fed meeting, one of the things I took out there was that we've actually seen a push back away from a loss of independence and some sort of increase in Fed credibility, in the sense that you saw Stephen Mirren basically coming out and saying, guys, come on my descent train, come on my 50 basis point. And, you saw Chris Waller and Michelle Bowman, who had dissented in the previous meeting. I think Jay Powell had basically set them aside, got them a coffee and said, look, guys, come on the 25 bag. And so if those two individuals had dissented with Stephen Mirren, I think the US dollar would be much lower than where it is right now, because that would sort of signal that he has some sort of influence with his uber bearish, dovish call. But they moved over towards more of a united front with Powell and didn't dissent. And I think that sort of regained some credibility and pushed away from that loss of independence in a way. And that's probably, it's probably not the only reason, but it is a small reason at the margin why the US dollar, I think, has pushed a little bit higher. I
agree with that, Chris. I couldn't agree with you more.
Thanks, mate.
I guess it's time that we need to move on. And you know what? We want to move on to the last topic, is actually the government shutdown. I feel, Chris, that we have to have this conversation.
No, we don't.
Every time.
No, we don't.
We do, because we have
Shame
a lot of
on
new
you bringing
viewers.
This subject up.
No, we have a lot of new viewers that are just like, but the government's supposed to shut down October 1st. What are we going to do? Look, the government is shut down. I have the notes right next to me. 1, 2, 3, 4, 5. I could go into the teens since the 70s on how many times we've had a government shutdown. Really, it's not a big deal. It isn't. We might have a few loss, depending on how long it's going to be. We might have some loss of services from maybe like jobs reports to CPI or certain economic data that we might not get. That might affect you and I. However, Chris, the reason why I do bring it up this time, it's not just because of that. And usually, I have to just kind of get past it, and we have to just muddle through it. And hey, a couple of days later, the they pass the bill, we get funding, we're off to the races again for another month and a half to 2 months. This time might be a little bit different. There's a very big deadlock right now in is it the Senate? We passed the House into the Senate. Anyway, Democrats are trying to really push for the spending bill for Medicare. I think it's Medicare and one other topic they're not willing to bend on. And Donald Trump at this point in time, I don't know if he will let the Republicans succumb to the Democrats demands. So we might end up being in a stalemate. Now, remember, the last time we were in a stalemate was a long stalemate, was December 21st, 2018 through January 25th, 2019. And that was 34 days of a shutdown. And that was during Trump's first term. We are in the second term of Trump, and he feels at this point in time, in my opinion, very emboldened. And anything to get, the news off of anything else he might be dealing with, the government shutdown might be the spotlight he's looking for to make his stand, to give Republicans a leg up as we go into midterms this next year. So I'm not worried about the government shutdown as of right now, but remember, the longer it goes on, the more we do have to be a little bit worried. I know you probably don't have much to say about it.
I've got lots to say on it, to be honest. I mean, I do think it's got a natural handbrake, and that is if you start. We talked about this last time, and if it starts threatening payments to servicemen and women, I mean that's just a massive political landmine that they just really don't want to go near. So it does have a natural handbrake, and we also know that if there's any kind of GDP that's lost as a result of payments not being made to certain, that will be then backfilled later on. So there will be a kickback. I think probably the story of the day, actually, we shouldn't be talking about the shutdown. It's actually the Arizona special election. I mean, it's put near your hood, right?
Yeah, it is.
We saw the Democrats win. So the advantage of the Republicans now is 219, 214 in the House. So that narrows down. And of course, it does suggest that there's a chance now that the Epstein files, so this is probably not a subject for a market subject, but it does in the near term bring up the Democrats' push to get the Epstein files released. And one suspects Mike Johnson, the Speaker, is going to try and find a way of loophole to get that blocked. But I think that does have bearing, not just on the Epstein case, of course, which a lot of people are looking out for. And a lot of people in America are really interested in how that's going to go down and what that could mean for some certain celebrities. But, also that for markets, I think, it does increase the stalemate now and the advantage that the Republicans have in the House. And, obviously we go into the midterms next November, and that majority is going to come even slimmer. That tends to be the case. So, passing stuff going forward is going to become even tougher. So I think that special election, whilst it was obviously a massively blue state, and it was a hugely blue sea, it was, I think the lady, I can't remember her name now, but she was filling in for her father who passed away. So it was always going to be the case. But yeah, we've now got an even slimmer majority for the Republicans in the House, which I think is going to be quite interesting going forward as well.
And, Chris, I really just wanted to bring up, the government shutdown because I wanted to tip my hat to Mr. Michael Brown for that.
Well, talking about that, there's going to be, it's really piss Michael Brown day off because I know that you've got a chart on the Dow in a minute. So let's go into, that's a setup.
Stick around.
There it is. I'm not going to go there. I'm not going to talk about the Dow, but I know you are. So I'm going to stick with the mighty Nvidia. Let's have a look at the daily chart of the Nvidia. Obviously, we got the push into. We actually made an all-time high this week, and it failed at that all-time high. It just couldn't quite close above that level. We were hoping to see. Well, I was hoping to see a full-on proper close with the price right at the top of the candle, and then I thought, this could really kick up into maybe $200, and we love the stock. I mean, the market loves the stock. A lot of people don't know why they love the stock. It's just because it's a momentum juggernaut. But for me, fundamentally, these guys report on the 19th of November. Their margins. When you look at semis, it is a margin story. That's what drives valuation. And their margins have peaked. They're going on the way up. We're going to get them 75%. They're probably going to come out 73.5% for this quarter, and they'll go up to 75%. They're going in the right direction. That's the short term, but the longer term, if you have a look at their project with OpenAI, 100 billion invested, it's a great setup, isn't it? You know, I'm going to give you $100 billion, and then over time you're going to buy an absolute shitload of our chips, and we're going to get that money back. And so, if that works out, then you're basically going to get a huge revenue stream coming through in the future. But it's probably, it's not a story for now. It's if they execute well and OpenAI will buy what they need to buy, then it's going to impact their revenue 27, 28, that kind of thing. But look at the stock now. We've failed once again at this all-time high. What happens here? I mean, the market is so dependent on what Nvidia does. Do we go down and test those recent lows, 164.07? Do we push through the high? I mean, I think this is a chart that everyone has to look at. You know, whether you're trading the Nasdaq, whether you're trading the S&P, all these kind of things. It really is. The variance is so important from Nvidia. Marvell actually is probably, if you want to go in the AI stocks, I think Marvell's had a big run. That's probably a better long trade at the moment. But this has to break through that ceiling of 184. And to get me excited, if we can get a close above that and a really strong close, range expansion, I'm long the stock again for $200. But we're at mercy of just where this goes in the short term. And I think a lot of other markets are really beholden to what this charted Nvidia does now.
Well, thanks, Chris. That is officially on my radar as of today. So thank you for bringing that to our attention.
That's good.
All right. Well, my first setup is going to be the dollar Mexican peso. And if you remember 2 weeks ago, I was feeling my boots when it got to 1822. And actually, my fill was 1824 post FOMC. I am long US dollar Mexican peso. But that's not the reason why I bring it up right now, because I'm bringing it up because it is a squeezable, Exsqueezeme type of trade. And if we get back above 1850, we start trading around the 1851 level, and you see equity markets under a little bit of pressure, or the dollar showing a little bit of signs of life, the dollar Mexican peso is going to be squeezable. Now, one of the other reasons why I love it is just because you look at all the carry trades out there, whether it's the
dollar
Brazilian real, the Brazil, the peso,
Colombian peso,
Argentina, you look at them and they're very, very aggressively. They've been aggressively bought at this entire year. And so if we're going to get any type of pullback above 1850 is where I think the squeeze starts. So I'm looking to actually add to my longs above 1850, and I think we need to be keeping an eye on it as long as 1820 holds on the downside.
It's an interesting one because the carry trade is so predicated on volatility. You know, carry relies on markets generally going sideways, or in this case, moving lower, and then you need very low volatility, and we've had that. FX vol's been shot to the pieces. The VIX has been anchored because of where realized volatility has been. And so the carry trades work well, but you've really gone into LATAM. I mean, I think you make a good point. Brazil, absolute poster child of carry globally. You've got the Colombian peso, as you mentioned, but also the South African rand's been a big one there as well. But, a lot of macro funds are all in the carry trade at the moment. And and that positioning could unwind. So if we got a bout of volatility, I think dollar MEX has got some really good upside in that situation. But technically, if it breaks through that level, I agree with you. But carry's been just the trade du jour in so many asset classes this year. But FX, it's all been about LATAM, and people are happy to pay up for the spreads to get that, to get the income that they can get from those yield differentials there.
It's great when it's working for you.
It is, mate. Well, isn't that the case with everything in life? But let's go to Aussie Kiwi, because when the boring becomes exciting, it's interesting because this is kind of like Euro sterling. It's kind of like people talk about it down under, and it's usually sort of because New Zealand and the Australian economy are generally quite correlated in some capacities. You do get a really good mean reversion move in this pair. That's not happening at the moment, and you are seeing relative growth, relative interest rates working completely fantastically for the Aussie dollar here. Now, we got a monthly CPI print yesterday in Australia, which was hotter than expected, 3% on headline, a little bit lower on core, on trim mean. But what we're looking now is the tracking rate for the Q3 CPI print, which is what the RBA set policy to. That's running far hotter than what the RBA, well, certainly hotter than what the RBA had looked at. So now what we've seen in Australia is the situation, we're not going to get a rate cut in September. There's zero probability of that. It was the November meeting where people said, right, you know, all the analysts were like, November's the cut. The swaps market had like an 80% probability of a cut, but we're now down at 50%. You know, after that CPI number and people extrapolating for the Q3 number, it's 50%. So you call that a line ball call. In New Zealand, though, I mean, their growth numbers have been horrible. And we're pricing nearly a 30% chance of a 50 basis point cut for their next meeting on the 8th of October. So you've got relative interest rate differentials, relative growth, momentum now kicking up, and it's at what, 113, just above the handle. I think this goes to 115 over time. Obviously, you know, this pullbacks will be going to happen, and you know, I'll be looking to, but you can see it's just hugging that upper Bollinger Band at the moment, and that's the sign of the momentum at the moment, and rate of change has picked up. It's looking quite good. This is just, I've seen a lot of people calling it a no-brainer trade because of that differential, and you've got to look at what's being priced into markets in the rates market and say, has it gone too far relative to that rates pricing? Pullbacks are a buying opportunity. As long as it's holding those short-term moving averages, hugging the upper Bollinger Band, stay long, it's a no-brainer.
You know, Chris, before we move along, I want to go back about three or 4 weeks ago. I can't remember. I was actually shorting the Aussie Kiwi just from a technical point of view at the 111.50
Did I tell you not to do that?
You know, yeah, and you said, hey, Blake, great trade just to do it, but I wouldn't stick around long. You're like, the Aussie economy, the Aussie Kiwi is going so much higher. Now, you said that 3-4 weeks ago, and it scared the crap out of me. I was going to short it again, and I said, nah, I'm not going to short it again. I made my 30, 40 pips or whatever it was, and it just ripped, obviously. I mean, so do you buy it today? I mean, you were telling us that a month ago that it was going to rally.
Hard to buy now. It's like a lot of these markets, Blake. I mean, this is the conundrum that every trader's facing at the moment. Sure. Do we buy the Nasdaq at all-time highs? Do we buy Nvidia at all-time highs? Do we buy gold at 3,700? You know, do we buy dollar yen, Aussie Kiwi at 113? All these markets have had a really big run. It feels horrible to buy now, and this is just the fact that everyone's facing at the moment. What do we do? What do we do? That's the. I'm gonna throw
the Aussie Kiwi in the buy everything trade. So I'm going to buy a pullback, Chris. I'm buying a pullback just for you. I'm going to do it for the Gipper. All right.
Okay, well, I don't think it's got much to do with the Fed. And I mean, this is just, the Australia's economy is doing okay. We've got a reasonably tight labour market. We've got growth at 1.8%. We're near potential. Anything hotter than 1.8% becomes inflationary. We've got inflation, you know, moving higher. And New Zealand, you know, their labour market's rubbish. Their growth is poor. And it's we've moved to, I know we've got a new RBNZ governor now, but when we start talking about 50 basis point cuts or at least a 25% chance of one, you pale that in comparison to a situation in Australia where people are saying, look, the RBA could be done here. You know, the RBA may not cut again. And I think that just shows that there's massive policy divergence between the two, which is your absolute bread and butter for FX.
Where's the new RBNZ governor from? She's from Sweden?
Riksbank.
Riksbank, okay.
I think she's getting quite a lot of love, to be honest. I think that people are saying she's the right lady for the job. She comes from a good CV, and she can turn this ship around.
The day Chris becomes a central banker. I know it's in the horizon, Chris.
Well, you'd like to be you'd like to go and work for the government because you get an hour lunch break to go to the gym, and you go home and you don't take work home with you. It's a simple life.
There you go. All right, I'm gonna talk about your favorite asset class and mine, and not Michael Brown's. The Dow 30. All right, and I know we've been prolonging this, but look, I'll tell you, I love to trade the Dow. Dow is actually a fun.
It doesn't matter. It's just a price.
It is just a price, but it's actually a fun asset class to trade. I trade the YMs all the time. I haven't in recent years, but in years past, it's one of my more favorite asset classes to trade. One of the reasons why I love this particular setup is because you see we had this ascending wedge. We broke out above the top end of the wedge. We are testing the bottom end of the wedge. That opens a move back down. If we start breaking lower through the lower red trend line, that takes us right down to the 50 DMA to the breakout point. Now, I'm not looking for I'm not looking for the Dow to lose 50% of its value or anything like that. But from a setup point of view, this looks like there's a trap door underneath that rising trend line. So basically underneath today's lows or so, that's where we start breaking down and retesting the 45,000 level, just above the 45,000 level. Like I said, it's a setup. Look for the 50 DMA. I think that's where all the action's going to be between, between the buyers and sellers. It's going to be a nice line in the sand. Yeah. You're going to get a lot of two-way price action around there, but I think it is a good setup for a potential sell-off.
Well, I think that's the difference here, isn't it? Because I just look at that, and as a trader, you just go, right, it's just the price. We're just trading a set of behaviours, trying to find reoccurring patterns and beliefs and behaviours. We don't care about what goes in there, what stocks are in there, whether it's a price-weighted market or a market. It's just, for me as a trader, just looking at it as a price. What is the probability of a move based on the aggregated flows that you're seeing in the price? It could be anything. It doesn't matter to me. I think if you're trying to use it as a benchmark, then forget it. It's a relic. But for me, I'm just looking at it as a price.
And price action is so critical, Chris. When you have false breakouts or breakdowns, it's just a key reversal for me. I mean, somebody got sucked into the market on the top side. They have to liquidate. They're poorly positioned, wrong-footed. Let them get stopped out, and we'll take that. We're going to prey on them because that's what we do.
Good stuff. Well, I know you love a pun. I know Michael loves a pun, but I love an acronym. So let's go to POTD. There we go. Right, I'm going to go with the big hitter, dollar yen. It's been bloody boring for ages. We talked about, I think this last week or the week before, and I was like, this trading the range, home on the range, and it's broken out. Is it time? I think it is. I think this goes up to, well, I'm not going to pick a target because this is when you get the breakouts. We've seen it close above the upper Bollinger Band where the volatility. The two standard deviations of the 20-day has come in. We've seen that contraction. And we've seen it break out there. We've seen it break out the trading range. It's closed near the highs. That's really important. When you get the breakout, where does price close in that range? And we've got it right on the highs. Now, what we want to see is the way that I'd be looking to trade. This is where your order execution comes in so much. So I'll be looking at a buy stop order just above the highs. And really what you'd be looking for then is hope that it kicks. Now, a lot of those do fail, and then you've got to be quick to just take that loss if it does roll back down and trade back through the lows, through the highs. But this is where it is. It's shown us that after this long contraction where the bulls and the bears have having this big argument, we don't really have the impetus to move it in either direction. But that's gone on for a decent period of time, and the contraction in volatility, the compression in volatility has broken out. Higher rates of change, firm breakout. Look to buy stop orders above the top of this and then hope it kicks. That's just the art of this situation. It may fail. Take the loss quickly. Take a small loss, but let it run if it goes.
Well, you know what could really complement your trade is my POTD, which is gold. And I believe that even the mighty can fall, or they can at least pull back. And that's what I'm looking at here. And by the way, just so you all know, when you have 161% extension, if you held a gun to my head, I would literally, that's one of the technical levels that I always trade around. So 161% extension is also known as the golden Fibonacci ratio. And so when you have
how ironic
price action, when you see price moving the way it is in gold around this key level, that tells me that there's going to be a tectonic shift in it. Not necessarily that gold's going back below 3,000. No, I think the gold could really back itself back up towards the 3,500 level and really retrace some of the rally just to the latecomers that you've seen here. And so you see that 50 DMA as price comes down. If it does come down from these levels, I think it's going to meet up right around that 3,500 level. And you talked about correlations, Chris, and how gold is an uncorrelated asset class. It is, except against the dollar. So when you see the dollar yen moving higher, gold tends to be moving lower. And I think that's one correlation that's come back into play post FOMC. So that is going to be my play of the day. I think gold does pull back. This is not something that you should be highly leveraged, looking for a huge reversal, because gold just looks like it could pull back.
You're weak. 400 to 1 leverage, smash it up, no stops, bang. No, I'm joking.
You crazy, man.
You're crazy. Man. I think the thing as traders is You know, you don't have this ingrained, I'm bullish, I'm bearish. You're trying to make a prediction, or you're trying to make an understanding about where the market wants to go, right? You're just trying to make a probabilistic outcome of where the market's likely to go. You know, where does the market want to take price, and how you see a skew in the situation. You're obviously saying, I just see a skew that it's now that it's likely to roll over and maybe come a bit low. But yeah, I think this idea about being bullish and bearish, I think this is just an idea that where does the market want to take price now? Is the probability ramped up that we could see a bit of a lower move? I guess that's the objective here. So don't think, all you gold bugs out there saying, oh, Blake's an idiot. It's just a little pullback, and we're just trading the price. We're just trading the flows, the beliefs, and the behaviours out there. So I would have liked to have actually gone on the trip of Bitcoin and Ethereum, because Ethereum's sitting on a really clear level, and we've had 3 days of indecision dojis. And the market, we saw that big liquidation playing through the other day. It was just all liquidations coming through, huge liquidations. But now the market doesn't really know what to do. So I'd like to see how that sort of rectifies itself and reconciles itself going forward. It's a chart we probably should have covered. Anyway, everyone at home, leave us the comments about how you're seeing crypto, Bitcoin, Ethereum, Sol, all those names as well. How are you seeing gold? Do you think Blake's right that we're going to see a little bit of a pullback coming through? What do you think about the dollar? Do you think you're going to see this French word renaissance kick in and maybe push up to sort of 98.50, maybe 99? Where do you see it going? Do you agree with some of our trade ideas? What do you like out there? Anyway, leave your thoughts and comments below. We'd love to hear from you. Blake, I'd love to hear from you all the time. And see you back next week for more of The Trade-Off. TTO.